to go ahead and get started. So welcome to the offering webinar for DFW Self-Storage Portfolio. Thank you so much for joining us today. We appreciate you taking the time to join our webinar. We really look forward to sharing this incredible value add opportunity in one of the strongest real estate markets in the country. And just some housekeeping points. We are recording this webinar and we'll be sending out the replay. So at any point in time, if you have questions, please type them into the chat box and we'll review them at the end of the presentation. So out of respect for everyone's time, we'd like to keep this to an hour. And if for some reason we don't get to your questions, or if you have more questions after today, please email the primary sponsor who you're working with. And next. Before we get started, I'd like to get our disclaimers out of the way. We are not offering legal advice. Please do your own due diligence on the offering, and please read all your offering documents that are provided in the deal room. Consult your tax and legal team. And lastly, we are just providing a general overview. So the opportunity that we're discussing today is the DFW Self-Storage Portfolio. This is comprised of 18 value-add self-storage facilities in the greater Dallas-Fort Worth metro and in East Texas. Before we dive into the details, I'd like to provide you a little background on the team who will be carrying out all aspects of an investment. And now we'll do a quick introduction on the team. My name is Mary Wynn, and I'm the managing principal of Blue Door Equity. I have over 10 years of project management, which includes work experience at a Big Four global consulting firm, high-tech startups, and for one of the largest nonprofit organizations in the world. I've been involved with real estate for over 18 years as a passive and active investor in a few asset classes. I'm a general partner and limited partner in over 1,300 multifamily doors and over 4,900 self-storage units. I'm a fund manager for 4 investments, and this will be my 3rd offering with our current self-storage operating partner. Next, I'd like to hand it over to Suja Sham.
Hi, everyone. My name is Suja, and I am the managing principal of Lux Capital Investment Group. I began working in the syndication space in 2010 as an underwriter for institutional equity partners. So my expertise is in vetting all aspects of the deals that we look at. I eventually left the institutional space to build my own real estate portfolio, which I did successfully. Within a few years, I replaced my income from working at financial institutions. And wanting to scale my real estate portfolio, I went back to syndications, which has been phenomenal. I've been a fund manager for several funds, and all of them are performing very well. We are very excited to be overperforming based on our projections for our investors. And thanks to my underwriting background, I love to analyze deals and find places that I want to put my capital into, and then invite investors to participate alongside of me. So I'd next like to introduce Ted Green from Spartan Investment Group to introduce himself and Spartan.
Hey folks, I'm Ted. I work here at Spartan in the investor relations team. Quickly, my background, I grew up at Merrill Lynch as an investment advisor. Have about 24 years of experience as an investment advisor. The last 6 of those, I was a chief compliance officer for a registered investment advisor firm and interacted regularly with regulatory bodies on what it looks like to do a due diligence, file and package and bill on assets that are exempt offering securities. A little bit about Spartan. We are soup to nuts. We do everything when it comes to our private investments, from sourcing the deal, syndicating the deal, the property management, the asset management, the construction. That's a big thing, a big value add piece. We own our own construction company, as well as the business intelligence. We've got 3 people that focus solely on where can we find a tertiary market that has properties for acquisitions? Can we actually build at those properties? How much can we build? Does it make more sense to build climate controlled or non-climate controlled? what's the square footage, on and on and on. So those are all things that are under our control, which gives us the conviction to bring these investments to individual investors, have them place their hard-earned dollars in the funds, and work with us for the next, what may be 4 or 5 years. A little bit more about Spartan. We're pretty active. We're growing fast. We have about 55 employees. We have made the Inc. 5000 list for fastest growing companies. Last year, we were named the 5th private real estate company, the 5th fastest growing private real estate company in the United States. We currently control about 12,000 units valued at about $250 million. We've currently got 9 properties down in the state of Texas. And once we complete the acquisition of the Dallas-Fort Worth portfolio, that'll take us to a total of 27 properties. So there's a little bit about Spartan. And Mary, over to you.
Great, thanks, Ted. So now I'm going to be talking about the offering highlights. And what we love about this opportunity is that we are in the Dallas-Fort Worth market, which is the fastest growing market from 2010 to 2019. Spartan plans to add over 160,000 square feet to the portfolio by building additional units to undersupplied markets that have high population growth. And due to the high occupancy at many of these facilities, the investment projects day one cash flow that we will distribute monthly to our investors. And most, if not all, facilities have great drive-by traffic and great visibility from the main road. So we have an attractive term sheet from our lender in the 3.5 range with 60 months of interest only. And as mentioned earlier, our operating partner, Spartan, has a strong presence in the market. And adding these properties will only increase payroll efficiencies and synergies. So the market surrounding each facility has high occupancy and most of them have higher rents. This is going to allow us to increase our rates to market and increase our NOI. So Spartan will be deploying many improvements and rebranding the properties to drive traffic and increase NOI, which will increase valuation to all facilities. And next, let's talk about the investment. So the investment hold period is projected at 5 years. A total of $37.5 million is being raised for the investment, and the minimum investment is $50,000. You can see there's a 7.5 preferred return, and a $50,000 investment conservatively projects an annual return of 18% with an equity multiple of 1.9 over a 5-year period. So when you're raising $37.5 million, there are several ways to meet that goal, yet remain compliant with the SEC. And so what we're doing is creating a special purpose vehicle, an SPV, called the DFW Self-Storage Portfolio LLC. And investors will invest into the SPV, which will in turn invest into the LLC that holds title to the entire portfolio. And so by investing a larger amount as a group, we're able to access an alternative share class with a better profit split beyond the preferred return. And the fund takes that delta as compensation. So in turn, our investors benefit from our relationships, our deal flow, and our due diligence. So let's talk about the cash flow. There's projected day one cash flow and sales upsides. There's cash flow projections for a $50,000 investor is looking great. You can see there we have a 6% cash on cash in the first year, and we exceed over 8% over the course of the investment. So investors all share in the upside from the sale for a total of $95,468. So that's a $50,000 return on your investment and a $45,468 of projected profit when you combine all the cash flow that you receive through the years and plus the sales upside. So now I'm going to turn things over to Suja, who's going to talk about the market fundamentals that will enable us to achieve our business plan.
Thank you, Mary, for kicking off the DFW portfolio opportunity. Hi, folks. I'm Suja, and I'm going to run us through the feasibility work that we have done on the area. So big picture, on one hand, we look at due diligence overall as an opportunity to verify all the information that was presented to us by either a seller or broker as true and verifiable. However, feasibility is external to the property and deal itself. Feasibility is about the market conditions that allow us to drive our business plan and produce our targeted returns that we have represented in our underwriting. So let's first talk about the Dallas-Fort Worth area. Our portfolio is split between Dallas-Fort Worth and East Texas. DFW is one of our favorite metro areas in the United States, as it is for many real estate investors. And that's because DFW was the #1 fastest growing city from 2010 to 2019 in the US based on raw number count from the 2020 census. And Dallas-Fort Worth was one of the 10 cities that has over 1 million people in the city proper. It's one of the most dynamic places, not only in the country, but in the world. It houses 21 Fortune 1000 companies like Dr. Pepper Snapple Group, ExxonMobil, Neiman Marcus, Texas Instruments, and that tells us that it's not just based on oil. It's a very dynamic economic landscape, and it's only becoming more dynamic. In fact, Inc. magazine in 2019 ranked Dallas as in the top 10 hottest startup cities in America. And while DFW proper is growing, the bedroom communities around DFW are growing even faster. One of the towns the team drove around recently was Forney, Texas, where they were looking at several self-storage opportunities. And in Forney, there was an expected 37% population growth. That's incredible. The next town over is Terrell, Texas. When this deal closes, our operating partner will own 3 out of the 5 facilities in Terrell, Texas, which is fantastic because that's going to be one of the fastest growing suburbs in the DF Metro as well. Spartan, our operator, also owns a property in Krugerville, right next door to Denton, Texas, another fast growing suburb in the DFW Metro. There is also a property called Big Toy Storage in this portfolio in Waxahachie, Texas. This facility has several housing developments going up across the street, behind the property, all over the place. Waxahachie is also one of the fastest growing bedroom communities in the Dallas-Fort Worth metro area. We have the benefit of being in the DFW Metro, but we also have the benefit of not competing with the REITs in these particular locations. We're in the suburbs. So REITs are the larger self-storage operators such as Public Storage, Extra Space, et cetera, and they tend to compete in the primary markets. We love the DFW Metro, but even more than being in the DFW Metro, we love being in the suburbs where we can own the individual communities in terms of the supply that's offered. The other half of the portfolio, meaning 5 out of the 18 particular locations, are in East Texas. East Texas is made up of 3 MSAs, Tyler, Longview, and Texarkana. Spartan, our operator, owns many facilities in the Tyler market, which is in the town that's closest to the Dallas-Fort Worth metro area, to the city itself. This will allow for operational efficiencies between the 2 markets once we purchase this portfolio. Blue Door and Lux, Mary and I already own 5 assets with Spartan in Tyler and Longview, Texas, and we've had exceptional results. In fact, Spartan's fastest growing lease up in their portfolio is in Longview, Texas, the next major town over from Tyler. It's a successful market because it is a hub for manufacturing, transportation, healthcare, distribution, and food processing operations. Also, it sits perfectly on the NAFTA corridor between Canada and Mexico for goods to travel between the 3 countries. All 14 locations with their 4 satellites are between Dallas-Fort Worth Metro and the East Texas Metro, which neighbor each other. Within these metros, the 14 properties and 4 satellites are spread across 8 counties. There are 254 counties in Texas, and 10 out of the 14 main locations are in the top 10% of net migration counties in the state of Texas, which itself is in the top 10 net migration states in the United States. So the overall demographic trends of the DFW portfolio are highly favorable. Now, I'm going to pass it back to Mary to walk us through the portfolio itself.
Thanks, Suja. Okay, now I'm going to provide a high-level overview of the properties inside the DFW self-storage portfolio. So there will be expansion at 5 facilities consisting of 160,000 square feet. Even though we have the ability to expand by 250,000 square feet, we're only creating projections based on 160,000 square feet to be conservative. So the facility average occupancy across the entire portfolio is 83%, and there's a strong market occupancy throughout the portfolio, which projects day one cash flow. The existing facilities are constructed with standard self-storage construction materials consisting of metal and concrete. So overall, they're very well-built structures. Next. I'd like to just highlight the 5 facilities that we have planned expansion in. Starting in Terrell, Texas, this property conveys with an extra 3 acres of expansion, as you can see on the screen there. It's allowing us to build at least 40,000 square feet in a market that has favorable conditions for the expansion. And it's leased up right now with a strong demand of 93% occupancy. Next. The next facility boasts a 99% occupancy in Tyler, Texas, and we are very familiar with this market. As Suja mentioned, we have a first offering in this area along with Spartan, and the asset was one of the best performing assets in our portfolio. So we plan to expand the facility by 55,000 square feet. Next. And the Flint facility has 10,000 square feet planned expansion, and overall, the facility has been well occupied at 92%. The next facility we're going to talk about is the Ferris facility. The property has 30,000 square feet of expansion planned, and it's just like Tyler, Texas. It's well occupied at 99%. So the last facility we plan to expand is in Paris, Texas, and that has an occupancy of 98% with also a strong demand. And we are planning to expand 25,000 square feet. So this slide, it's hopefully you can see it. I know it's a little bit small on the screen, but page 16 of our offering memorandum also breaks down all the traffic counts here, the market occupancy and the expansions plan across each of the 18 facilities. We also have a detailed feasibility study and local market comps in our investor portal. So you can go to our portals for a little bit more detail as it outlined on this slide here. And next, so each of the properties, Spartan rebrands to the national storage brand Free Up Storage, and the portfolio has significantly under market rents. Upon takeover, the team immediately kicks off rate increases. So the staff is well trained and store managers are held to the highest customer service standards. Spartan enhances marketing efforts and requires the tenants to have rental insurance, which serves as an immediate additional revenue stream. And with that, I'm going to hand it over back to Suja, who's going to walk us through the underwriting of the investment opportunity.
Thank you, Mary. Suja here again. And folks, I'm going to walk you through the financials that mirror our underwriting file that's available on the portal for this opportunity. So the first data point that I want to cover is revenue growth that we're going to achieve between years 1 and 3. So we're looking to go from gross potential rental income of 7.3 million to over 10 million in 48 months. And how do we expect to do that? There are a couple of different components to our business plan, but the first is we're going to push the street rates by 16%. And that's because we look at the comparable rents in the marketplace today. Class A grade assets, B grade assets, and C grade assets. And then we look at what is going to be the grade of each of our facilities after we inject the $3.4 million of initial improvements across the entire portfolio. And when we make that comparison, we see that there is a 16% blended delta across the portfolio between where our rents should be after our quality grade improves across the entire portfolio and where rents are today. So we're going to be pushing our street rates by 16%. But it's not just the street rates. The market occupancy of the vast majority of these locations is 98, 99%. And our economic occupancy is currently around 80%. And there's no reason why it should be that low other than manager lack of efficiency. So we're going to be increasing collections by 32% in the first 24 months. And that doesn't, just to clarify, that doesn't mean we're going to expect to be able to increase the street rates by 32%. That just means that we're going to get rid of the discounts. We're going to get rid of the delinquencies. We're going to remove the friends and family who are paying 30, 40, 50% less than some of their peers who are paying street rates today. So in addition to reducing those efficiencies in the economic occupancy, we're also going to increase the street rates by 16%. So that is one part of the business plan. Operational efficiencies get to a point where the asset quality grade can demand the extra 16% or more on the street rates and increase our collections such that the overall revenue growth on the existing supply is close to 32%. And we're giving ourselves 2 years to get there, which we believe to be very conservative based on our past experience. Part 2 of the business plan is to take advantage of the 250,000 square feet that we could improve upon. So, although we've looked at the markets across each of the 14 major locations assessed, not every facility should be approved upon with additional supply. Just because we have the land doesn't mean that we should build the additional supply. So there are 5 locations that we've determined that not only do we have the space to expand, but we also have the market conditions that are right for expansion. And between those 5 locations, we've determined that we can build 160,000 square feet at least to start with. There is more room, but that's why we underwrote 160,000 square feet to be conservative. And we believe that we can achieve that with a very high level of confidence. That 160,000 square feet is going to make up half of the additional revenue that we're going to be achieving between year 1 and year 3. So yes, it is a 50% gross potential rental income in 24 months, but it is achievable by way of the market conditions on our existing supply, our construction and improvements, and by adding new supply of 160,000 square feet, which is almost a 20% increase in the supply of the portfolio today. So the second data point that I want to focus on is debt service. The debt service coverage ratio or the debt yield, depending on what you like to look at, are 2 of the best metrics to look at in terms of risk. Banks like to see a debt service coverage ratio of 1.25 to 1.3x of NOI. That means that you can cover your debt service and still have a cushion of 0.25, 0.3 left over on top of that debt service, meaning an extra 25 or 30% in excess of the cost of your debt is profit. At least banks want to make sure that you are profitable with the debt service in our first year. And in our first year, based on the terms that we're anticipating, we expect to have a debt service coverage ratio of 2.1, and it's only going to go up from there. If we maintain an IO period in year 3, the debt service coverage ratio is going to be over 3, much better than the 1.25. And even if we have a conversion to an amortized payment in year 4, we're still looking at a 2x debt service coverage ratio by that year, which we feel extremely comfortable with. However, based on the conversations that we're having right now, we believe that we're going to be able to have an IO or interest only period for the entirety of the whole period of 5 years, but we underwrote an IO period of 3 years to be conservative. We are also targeting a rate of 3.25 and to include the construction component at 70% loan to cost. Our primary course of action is to achieve that 3.25% interest rate on 70% loan to cost on all of our items. That includes the $88.5 million of acquisition, the $3.4 million of initial improvements, and the $9 million plus in construction costs for the 160,000 square feet of expansion. The final data point I want to call your attention to is property taxes. Our operator has a lot of experience collaborating with multiple counties in the state of Texas and leveraging the laws built around equitable property tax assessments to make sure that we have the best outcome. So we feel very confident when we look at our competitive property tax dollars per square foot in the market to determine what our property tax increase is going to be. And so we've conservatively estimated that the property taxes blended across the portfolio are not likely to be higher than 40 to 50% increased, but we've underwritten a 59% increase in our portfolio property taxes to be achieved in month 18 of this portfolio. So we're underwriting an increase of the property taxes pretty early in the portfolio, and we believe that this is fairly conservative given the conditions of what we've assessed across the competitive landscape in each of the different 8 counties. So walking through what this means for each 50K investor, the total operating returns on every $50,000 investment is $20,621 and $24,800 for the sales side after liquidating the assets. That's approximately a 45-55 split between the two, cash flow and liquidation. The total return works out to 18% annualized over a 5-year hold with an equity multiple of 1.9. Of course, we always like to look at what is our worst case scenario, what is our best case scenario, and what is our likely scenario. We can't guarantee that the returns are going to fall between the worst and best cases, but we have a very high level of confidence given Spartan's historical performance over the last half decade in self-storage that it will fall between this range. So while we're targeting an annual return of 18%, we have a high level of confidence that the returns are going to fall between 12 in our worst case scenario and 25 in our best case scenario. And the variables that change between the worst case scenario and the best case scenarios, those are some of the more meaningful assumptions that we can tweak. What is our assumed cap rate? What is our assumed rent growth? What is our assumed hold period? And what is our assumed lease up rate on the expansions that we're doing? So these are the major variables that we are considering when we determine the likely worst and best case outcomes. So with that, I'm going to hand it over to Mary to discuss next steps.
Thank you, Suja. So we are really excited to be working with Spartan Investment Group again, and we've received a fantastic response to the DFW self-storage portfolio. Our first offering with our operating partners has truly proved to be a gem in our holdings, and it's been one of the best performing assets under management. So if you're interested in moving forward with a DFW self-storage portfolio, the next steps are to register in the investor portal under the fund manager you're working with. If you already have an account, log into the investor portal and place a soft reserve. If you need access to the investor portal, please reach out to your respective fund manager. So from the investor portal, you'll find the documents pertaining to the offering. The PPM and subscription agreements should be ready in about a week. So we'll notify you when the legal documents are ready in the investor portal for your review and signature. And once we approve the documents, then we'll go ahead and notify you to submit your funds. So now we will go over any questions. If you have any questions, please put them in the chat box. We did have some questions that were emailed to us ahead of time, and we've also been kind of just filtering a lot of questions. So we'll go ahead and review some of the frequently asked questions. What is the purchase cap rate and exit cap rate? Suja, you want to take that?
Yeah, so the acquisition cap rate based on historical data is 5.15%. And currently similar stabilized portfolios are trading between 4.5 and 4.7 cap rates today. And while we expect cap rates will continue to compress, we have underwritten an expanding cap rate for conservatism. So the exit cap rate is projected at 5.35%.
Suja, could I jump in on that?
Yeah.
So This is by the way, everybody, this is Ted. I'm part of the investor relations team at Spartan. This is a little bit of it's frankly a really big topic. I'm going to touch on some high points. This will take like 90 seconds. During 2020, in August, the Department of Labor made a change to ERISA plans so that 401k plans, 403bs, 457s, all of those are retirement plans in corporate America. Those assets are now able to invest in commercial real estate in the target date retirement funds. So don't hear what I'm not saying. I'm not saying that Spartan is taking phone calls from 401k plans that want to invest in our syndicated assets. Rather, we are in regular conversations with private equity firms. Blackstone is one, where they are very serious and interested in acquiring large portfolios on behalf of their corporate retirement plan clients. So it looks like as follows, a $300 million portfolio that has real high quality, high occupancy, Class A properties that have been expanded and are cash flowing. They all run on Oracle's enterprise accounting software. They're all running on StoreEdge software, so that on behalf of the retirement plan, the private equity firm can own and maintain that asset, again, on behalf of the retirement plan. So back to the question, what's the exit cap rate? We've seen portfolios like this sell in the high fours. Suja, Mary, and team have modeled what they have modeled. I'm here to tell you that the majority of this portfolio will probably be sold as part of a larger transaction sometime in 2023. And the cap rate for that larger portfolio, $250 million or $300 million, is very likely to be in the 4.5 or the low 4 cap range. We've seen some properties sell in the high 3s that are part of a larger portfolio like $300 million. So yes, the underwriting that I've seen is conservative. Yes, there's also room for additional upside pressing into the low 4s as opposed to the mid 5s. So sorry to go so long, Suja, but now I'll be quiet.
Thanks, Ted, for that input. That's helpful. So who is the seller and why are they selling? I'll go ahead and take this. So the seller is a mom and pop, and they are liquidating their assets and moving on to retirement. So we are taking advantage of that in our larger portfolio. The next question we had was, how do we plan to fix the delinquency issues? Ted, do you want to take that?
Yeah, in this space, friction is, it's what happens. We lose some tenants when we move in to raise lease rates. There's a large institution called Yardi, Y-A-R-D-I. Yardi just published the trailing 12 months rent rate, what has happened to self-storage rent rates over the trailing 12 months. The article is relatively brief. It doesn't give a lot of breakout as far as climate controlled, non-climate controlled, Class C versus Class A. But what they have stated in the trailing 12 months is that non-climate controlled lease rates are up 10% year over year. Climate controlled rent rates are up 12% year over year. So back to the question, there will be friction. We will lose tenancy. The good news is that from our perspective, this is a property that can overcome the drag from the friction by finding new tenants. This is our business. We brought the money. This is now our business. They may have, a former tenant may have been able to get a favor out of the former owners or whatever the situation, but that stops now because this is now our business and we don't mind friction as we raise rents, defend our investors' capital, and pursue new tenants. So friction it's part of the process and we're okay with that.
Thanks, Ted. Another question we got was, what is the break-even occupancy? Suja, you want to take that?
Yeah. So the levered situation, which includes debt service payments, the break-even occupancy when levered is 65%, which we're really, really comfortable with. The property is currently operating at 80% economic occupancy. We plan to be able to increase that quite significantly. And so there's a lot of room, and we're very comfortable with the break-even occupancy that we have.
Great. So what does the debt picture look like, Suja?
So we're going to be getting $71.1 million in debt. It will be provided by one lender for the entire portfolio. And we have plans to have interest only for the full 60 months, although our underwriting only reflects 36 months of interest only. So we've got some conservatism built into our financial analysis.
Great. A question we had was the debt service. What is the debt service coverage ratio? Suja?
So we're at a healthy, around 2x on the debt service coverage when it's looking at an IO. And that's only going to increase over the period of the loan. And as I mentioned in the presentation, we're projecting to be at a 3x in year 3 if we continue with an IO period, and otherwise we'll be at around a 2x.
Great. Okay, so how has COVID negatively impacted self-storage? Ted, you want to take that?
Yeah, it really hasn't. COVID has impacted tragically. It has impacted our country and the world. But what COVID also has done is it has caused life events. Life events cause users and tenants to need storage. We saw an increase, a fair amount of increase of business owners who had closed a retail footprint where they may have been paying $2,000 or $2,500 a month and put both equipment and inventory into storage and paid maybe $200 a month. So when you either have a business or an individual consumer who is dealing with life events, it's very similar to changing the oil in your car. You just do it. Things may have changed in your life, but you still do it. We really have not seen a slough or a fall off of tenancy in our properties. And in fact, our entire portfolio of storage properties, with the exception of one property, everything is remarkably above pro forma. The one property that we were dealing with had a elevator issue, a significant property tax issue, which we have since resolved. That property is now back above pro forma. On the whole, the storage portfolio at Spartan is performing very well. And it's driven by life events, and life events don't stop because of COVID. In fact, they trigger new life events.
Thanks, Ted. The next question we had is, how will we eventually sell? What is our exit strategy? Ted kind of mentioned some of that earlier, but did you want to go ahead and elaborate a little bit more, Ted?
Yeah, so in 2023, it's plausible, it's reasonable to expect that Spartan will sell some properties. It may be that we roll up our entire portfolio and sell the entire portfolio for a blended cap rate that would be higher than if we only sell our Class A properties. Don't hear what I'm not saying. We're not leaving the industry in the event of a partial portfolio sale or the entire portfolio gets sold. This is a rinse and repeat model where we've built the infrastructure to go out and do this again and again. It's a function of the yield curve. Earlier this spring, it seemed like interest rates were going to hit 2% on the 10-year. We're back down to 125 basis points, which means that investors, both large and small, are very serious about finding assets that throw off cash. Interest rates are at 0. Price earnings multiples in the stock market are upper 30s. There's a lot of room for both stocks to give ground as well as bonds to give ground. if interest rates start to rise. That's one reason I'm so adamant and so intrigued by this space. We drive net operating income higher, which makes the asset worth more. We can fight off a rising yield curve by driving NOI higher. So the defensibility of this asset class, it's truly remarkable. You know, recession, near recession in 2020, and rent rates across the country marched higher by 10%. So anyway, that I could go on and on, Suja. Now and again, you just got to shut me up and turn off my microphone.
Thanks, Ted. We had a couple more questions come through, so we'll go ahead and review that. If anyone else has questions, please go ahead and put them in the chat. Another question that had come through was, will a cost segregation study be completed to accelerate?
Suja, if it's okay, I'll jump over Mary on that one. I didn't hear the last part of the question, but we use Madison specs for all of our cost seg studies. The bonus depreciation pass-through will be 34% on the DFW investment. So think of it this way: years 1 through 4, the cash flow is the cash on cash distributions are covered. You might be halfway through year 5 before you've burned up your bonus depreciation that can be used to offset the passive income. So now I want to highlight just a couple of things. Number one, always consult your tax advisor. I may sound like I know what I'm talking about. You may have a nuance to your situation. So it makes sense to consult your tax advisor. Another thought, if the loss from the investment is your only business activity in the state of Texas, you don't need to file. That's my perspective. You should check with your tax advisor. I'll be quiet again.
Thanks, Ted. I have a couple questions that came through recently. One is, will Tyler Longview be absorbed into the DFW portfolio? And just for reference, Tyler Longview is a different portfolio that was purchased in a similar area about 1 year ago by Spartan, and Blue Door and Lux are invested in it. It will not be absorbed into the DFW portfolio. It will be a completely separate deal. And, you know, as we've been discussing, all of the properties across the Spartan portfolio may be packaged up in one way or another and sold off together, but that won't happen until it's an appropriate time, an optimal time to liquidate. And then I have another question, which is the interest rate of 3.5% locked for 60 months? And I believe that I actually do not know what the loan firmed up at. I know that it was definitely confirmed for 36 months, and I don't know if it will be confirmed for, but the interest only. Ted, do you know actually about the interest rate?
I'm 98% sure that it's fixed at 3.25%, and then it starts a 25-year straight line amortization schedule. We will likely be gone in 5 years, but a little bit higher principal and interest payment would kick in month 61.
Okay, thanks.
Suja, did you have any other questions come through? I just had one more on my end.
Okay. Yeah, so there is one other a question, which is, will independent appraisals be performed on each property by licensed appraisers? If so, when will those be completed and available? I believe that is part of the lender due diligence. Ted, can you confirm?
Yeah, so the answer there is yes. Speaking from the 10,000 foot level, it's surprising to me the reliance that the appraiser has on the work that the acquirer has done. So oftentimes is the case, and this is, 25, 27 times now, we've seen the appraiser rely on us for the due diligence and the documentation that we've done. And so oftentimes is the case, the appraisal comes back, within spitting distance of the acquisition price. We did get some movement recently in one of our properties with a different portfolio. We scrambled the night before closing. We went to one of our investors, borrowed $1 million, and we got to the finish line, which is, as you know, you always call an audible late in the game for something. So, but back to the question, yes, it's surprising to me how much those appraisers rely on the work that we've done, and it generally comes in very close to the acquisition price. It's just how it goes.
Okay, thanks, Ted. What is the timeline for closing the deal? The deal will close on September 30th. So we are, working to get as many funds in before the 30th as possible. And there likely will be some opportunity to fund the deal after that. But as always, the investments are on a first come, first served basis. And that's all the questions that I have. Mary, I think you had one more that you wanted to bring up. Okay, well, I think, Mary, did you have one more?
The last question I was, how is, yeah, can you hear me?
Yeah, sorry, you froze for a second. Go ahead.
Okay. How is Spartan accounted for increasing construction costs? Ted, you want to take that?
Sure. So we have not bought the steel yet. Steel prices seem to have plateaued the last 6 weeks. Once we're under contract, we go ahead and we just pay the freight. It's just one of those things that, you knock that one down as soon as you get into position to knock it down. Yeah, it's not a bit. We're not afraid of that. That's not a risk that could impact us. It doesn't feel like at this point.
Okay. All right. Are there any more questions, Suja, in the chat box? Nope. Okay. All right. Well, if there aren't any more questions, we'd like to thank everyone for your time. Please reach out to your respective managing principals who you are working with if you would like to move forward with the next steps. And thank you again, everyone, for attending the webinar.
Thanks so much for coming on, everyone. Really great to see you, and we'll see you next time.